and 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. Podcast. Okay. You know, tomorrow's going to be a big day because NVIDIA is reporting. Now let's think about what's going on. NVIDIA, if they come in with bad numbers, then all these AI stocks will just go down big time. If they come in with good numbers, then everybody's going to rally these stocks up big, and everybody's going to say, hey, it doesn't matter about the yields. We don't care if they're 4.6, 4.75, who cares? There's such demand. But before I get into that, what's really interesting is most people don't understand what this whole AI thing is about. I didn't until I really researched it, and I was stunned to find out what it's really about. Now, first of all, if we go back and compare what was going on with .com, the .coms had about 45 companies that made up 70% of the S&P gains. AI has just 12 companies that make up 70% of their gains. Now, when you think about AI, you think really what they do, if you break it down, it's quite amazing, because the whole AI boom is based on the idea that Microsoft, Amazon, Google, and Meta will keep building bigger storage units. In other words, these storage units, like 30 trillion each, whatever they are, ridiculous. There's 4 companies that have the money to build these. And what they actually do, just think of it as storage units, like put all their crap in there. And this AI boom is based on 4 of these companies. So in other words, this whole AI boom, if you take Microsoft, Amazon, Google, Meta, they keep building bigger storage units, and they hold all their stuff, okay? And they store their data. They run their models, train the models, power the models, cool the models. That's what they do in these huge buildings. And so again, there's no real industry. There's just 4 companies who have the money to store all their data. That's it. So those data centers, okay, all funded by Microsoft, Amazon, Google, and Meta. So AI, as we know it, talk about it, grows because it doesn't grow because it's something the world wants. It's unbelievable. So AI, the industry, okay, doesn't grow because it's the whole world demands it. AI grows because 4 companies keep paying about $30 trillion every time they build a storage unit. So how does AI grow? And so AI grows, I mean, think about it, when 4 companies build another storage unit. So this whole AI is surrounded by, you got 4 companies, that's it. And when all of a sudden, if one of the companies gets in trouble and stops spending, this whole scheme is gone. So again, what's amazing about it is, if you really simplify it, it's just a storage building, huge storage buildings that cost billions and billions of dollars, and The world doesn't want them. Consumers don't want these buildings. Enterprise need it. And I mean, enterprise don't need it. Government doesn't require it. AI grows because four companies keep spending money. That's AI. Can you imagine if something happens to one or the other, or one of these four companies, what would happen? So if you think about AI data centers, and that's all everybody talks about, okay, I mean a lot of it, not all, and it comes from a customer base of four. That's it. That's it. It's crazy. So again, the people who made all the money was these four companies needed these chips and chip machines to go inside these storage units. So who made all the money were the four machine makers. Chip machine makers, ASML, Applied Materials, Lam, KLA. They were huge winners in this AI boom because they built the machines that make the chips. And they needed these machines for what they do in this big, huge storage building. So when you hear there's an AI boom, there's really no AI data center boom. There's really no boom. So again, there is only four companies funding the backbone of data centers. I know I keep repeating it, but it's amazing. I mean, each one costs about $10 billion, okay? And Microsoft has already spent about $60 billion, Amazon $55 billion, Google $50 billion, and it just amazes me to think there's no other companies who have the money. And I mean, can you imagine this whole AI deal is built on just a foundation of four? It's just, I don't know, it's just something I wanted to bring up because to me, it was just amazing. I mean, it's just crazy. So if one of these companies fail, okay, or not only have to fail, if one of these companies stops spending, then this whole AI supply chain will collapse. But anyways, I just wanted to bring that up because that's really what AI is about. In fact, what Trump's been trying to do, because Trump identifies it, how I'm seeing it, this is nuts. This is nuts because there's no demand, there's no customer base, there's no enterprise wave, there's no consumer AI boom. It's four companies doing all the buying. And so Trump is trying to get investors to rotate out of these AI data centers who are investing in these centers and to put money in energy and industries and defense, real stuff, not a big storage building that you put crap in that takes care of the crap of four companies. So that's what Trump is trying to do. Anyways, let's get off of that for a moment. It just amazed me because the more I dug into it, I'm going, what industry? This is no industry. Are you nuts? So let's talk about what's going on tomorrow. So we have the chips and the chip machine makers and the chip buyers. Okay, so since Friday, now remember since April, when we were at 4.25, and the yields at 4.25, and they started to creep up, I kept telling everybody that you gotta understand when we hit 4.50, all hell breaks loose. It's a killer. It's a trigger. Okay, that's when these companies can get really hurt. And what happens is, as investors start pulling their money out, they go buy bonds instead. When you buy bonds, yields drop. And so that means the crash gets worse and worse. Now you would think, most people think at 4.5, this is bad, we hit 4.5, 4.6 today, this is really getting bad, right? Because remember, tech wants low yields, not high yields. And these yields are crazy high. Doesn't help them, it hurts them. And then people think, well, when the yields start coming down, then that helps them. No, it makes things even worse. So that's why they got hit last Friday, and they're still getting hit. But today it feels like the market is just like stalled or went to sleep, right? And it's for a good reason, because tomorrow's going to be a huge day, because again we got the Nvidia coming out, and Nvidia is going to set the tone. I mean, if Nvidia comes out with good numbers, then everybody's going to say, "Oh, demand is so big." Okay, Nvidia's demand for their products so big that we don't even have to care about yields anymore. That'll go on probably for about 2 weeks, and the market's just going to explode, right? Nobody cares about yields. So again, if you're in these tech stocks, I'd suggest that if you got a lot of money, to take some money off the table tonight, because we don't know what Nvidia is going to do. So we could either have a big boom and nobody cares about. I mean, look, I think about from 4.25 in April to May to 4.5, nobody cared until we hit that 4.5. And I said it many times, once we hit 4.5, this thing's going to hit and go down, and it did. So understand this. So the chip has hit we've hit the kill zone, the yield at 4.50, and it keeps climbing. So, and again, most of the action is with the chip machine makers, those stocks, which are 4, and then the 8 companies who buy, these chip machines. So, but I want you to think about this. This .com, it's so leveraged, it's unbelievable. Everybody who's buying these stocks, these 12 stocks, they're the most leveraged ever. The margin, the debt is huge. It's about $850 billion. I mean, just huge. .com days was around $250 billion. And our margin debt at $820 billion, right? People are borrowing like crazy to buy these 8 stocks. And the margin debt's insane. It's only 7% below the all-time high. So this is the most overbought, most leveraged. These chip machine makers and the chip machine stocks, buyers, those stocks, they're so leveraged. It's incredible. And again, you got not only the margin debt, but the chip stock contribute, as I said a moment ago, 70% of the S&P gains. And in the .com days, there was around 35 to 40. So that makes a big difference. So just one thing's got to get screwed up. And if we have a bad day tomorrow, and I don't think NVIDIA's going to come out with a bad day, okay, but know how fast everything would unwind? And then you got the 4 companies with these storage data centers, right? And that people are investing into. And, Microsoft and Amazon and Google and Meta, which is fine, as long as you know how to sell short, as long as you know how to put stops in, as long as you know how to manage your money. We're invested in them. But at least we know how to short, we know how to manage our money, we can identify when something's going to go wrong and move our positions out before it happens. That's fine, but you got to know how to do that, or one day everybody's going to get clobbered worse than what happened with the .com days. So the .com crash, as I said, the margins then were $250 billion against $820 billion today. And what people don't understand is right now, these 12 stocks, are the most over-owned stocks ever on Wall Street. I mean, think of these 12 stocks out of 5,000 stocks that trade every day, or just take the 700 stocks, which includes the S&P, the NASDAQ 100, the XLK. I mean, 700, there's only 12 stocks everything's riding on these 12 stocks. But the yields right now are 4.6. And the biggest reason these yields are soaring is because they came out with the CPI. And the CPI had, tremendous inflation. And they're saying how strong the consumer is. No. The consumer's not strong. They're not selling more units. It's just the prices of what you're buying last week is going up again. So it makes it look like, boy, the consumer's strong. He's out there really buying a lot of stuff. No, he's not. He's hurting, okay? And he's buying less, but prices are going up. So yields at 460. If we hit 475 or get close to that, then you'll see this thing really unravel, unbelievable. So the biggest reason for these yields is because the CPI, that brought the inflation up to a 2-year high, and the Fed is not going to be cutting rates. As soon as you hear the Fed's not going to be cutting, they can't cut rates. Impossible. They can't cut rates. So this is going to be very, very bad. And as I say, since Friday, the chip machine makers lost between 7 and 8%, and the people who buy the machines, the companies buy the machines, they lost about 7%. Now, so tomorrow we could either get all that back if they come out with good numbers in some, or if it goes bad, we could go down 2-3 times what we've already lost. So that's something you have to watch, okay? So today, if it feels like the market's not doing much, it's just because the investors are really reassessing tech valuation. These stocks, they're hugely overvalued. And again, remember, the spiders increased 30%, and the NASDAQ increased 70% between 2022 and 2026. So they're reevaluating, going, man, I don't know, maybe I should be in something else, okay, than these tech stocks. And the higher yields are really going to crush these tech stocks that everybody's in, these 12 stocks. So you got to be very, very careful. And all this is going to hinge on one report tomorrow. So this could be very, very bad. Now, the banks like high yields. And we've been shorting the banks. But the problem is the yields right now, the banks can't make money. They just can't make money right now. It's really almost impossible for them to make money. Because, again, when you look at the credit spreads on these banks, the good thing about the credit spreads is they're telling us that the banks are safe. We're not going to have another 2008 banking crash, okay? So the credit spreads are safe because we're under 90 with the credit spreads. But you can't make money being safe. You got to make sure that we get the yield curve up to 150, at least up to 150, and the credit spreads ideal is between 150 and 200. And we're just not near there, okay? So you've got to really start watching these credit spreads very careful, okay? Because, again, if we start getting between 120, climbing above 120 on these credit spreads, that's a crash warning. The beautiful thing about these credit spreads, they're the first thing, they're always accurate as to when a crash is going to occur or something's in trouble. And between that 120 and 150 on a credit spread, it's telling you the banks aren't safe anymore. Now, the yield curves for these banks have to be at 150 for banks to really make money. The banks aren't making money because the yield curve on these banks are nowhere near 150 right now. They're more like near 77, okay? So again, and you got to have the 10-year yield around 6.3% for them to make money, and they're nowhere near there. They're about, I think, 4.59 or 4.6 right now. So the point is, these banks, they're a good short position right now, okay? But you have to be patient with the banks because what's happening is again, the banks are in trouble And you look at the yields, they can't make money where the yields are right now. So but you start, every time you start buying these bank stocks, you start shorting them, you start seeing them go up a little bit, don't panic. Because what that is, people who buy and hold, a lot of people are pulling their money out of tech stocks and they're putting their money back into the banks. They want to be in something safe, the banks. So you get these snapbacks. But the trends are still going down. So even though you get these snapbacks, the money flow, the trend, money coming out is still going down. So I think if you're patient with these banks, and you can join our gang, we'll show you how to trade them. But I think those are going to do very well over time on a short. There's a lot of pressure on them. And the only place that I really see that, and we're starting to make money on too, is the oil service sectors like Schlumberger, okay, those different sectors. Because when oil prices start going up, when you get oil prices going up, that is very helpful because the big companies like Exxon and the rest of them who go and find the oil, they explore for it, and when they find it, they need to order equipment and machinery and crews from Schlumberger and the other Halliburton and the other service companies. And those stocks are all starting to break out now. And we've been buying these stocks, and they've been doing well. So really where we are with the market right now, I mean, it's dangerous from a point of view is I want you to think about this. The market is worse than the dot-com days, much worse, okay? Because we only have 12 stocks holding up the whole stock market. And a big piece of this market, okay, are these companies that are building these data centers, which there's no demand for. All it is for their stuff. When they build these big buildings for $30 billion each or whatever they are, it's only to put their stuff in there. And the 12 stocks that are doing the best, okay, that everybody's making a ton of money on, the 4 chip machine builders, okay, and the 4 companies who buy these machines, those 12 stocks are booming, but that can all change tomorrow. But those stocks, okay, have been holding the whole stock market up. And again, when you go back and you look at where all the activity is with these data centers, you have 8 companies building the stuff that 4 companies that own these data centers need. And they just selling that stuff. And one day this is all going to stop. But in the meantime, stay with the trend, keep buying. I mean, but again, you never buy stocks unless you know how to sell short. Anybody that's in the stock market that doesn't know how to sell short and you're trying to make money buying, you will get crushed. At some point, you'll get lucky, you'll make some money. But at the end of the day, that's why 73 to 93% of people lose money in the market. There is no way you can make money consistently by just buying stocks. It doesn't work. It just doesn't make any sense. You got to know how to sell short. Okay? I mean, you wouldn't buy a car with forward with no reverse, would you? Of course not. Same thing. So again, we have tomorrow's going to be critical. NVIDIA could either take this whole market down, or it could take it and expand it big time. All these AI stocks that I'm talking about. When I'm talking AI, I'm talking to 12 stocks. That's the backbone of the market. These 12 stocks. We're down to 12, driving the whole stock market. You know, and everybody says, well, 12 of 700. No, 12 of 5,000 stocks. There's 5,000 stocks out there to trade. Okay, that's how crazy this is. So, but it's made a lot of money, these stocks, and it can still continue to go up. As long as, and this is the thing you got to remember, as long as Microsoft, Amazon, Google, and Meta keeps needing storage buildings for their crap, AI stocks will continue to go up because the crap they need is being built by the 12 stocks. They're being built by your machine makers, AMAT, LRCX, ASML, and CLAC. Those four are making the stuff that goes to that Microsoft, Amazon, Google, and Meta buy from them. So the stocks you want to be buying are Microsoft, Amazon, Google, and Meta because they buy these machines. So you got this narrow little space where all the money's going. Where all this money's going. And it's going it is crazy because you got big storage buildings, that's all they are. And Microsoft, Amazon, Google, and Meta gets on the phone with the forced companies, AML, LRCX, and the clock, and say, look, we're building another storage building for our crap, and we need, for all that crap to work inside, we need some more of your chips. We need your chip machine to make chips. And so that's the market, and you can keep making a ton of money going long and hopefully one day shorting. So I wouldn't be waiting, to put your money anywhere else right now just doesn't make any sense. But you got to learn how to short because one day this is not going to work anymore. You really believe 12 stocks can hold up this whole market and not ever run into trouble? I mean, if the dot-com ran into trouble when they had 40 stocks, right? 40 stocks was 70% of the S&P 500 gains. 40 stocks was 70% of their gains. We got 12 stocks, okay, just 12, 70% of their gains. So stay with these 12 stocks, work them, keep your ear to the ground on Microsoft, Amazon, Google, and Meta, because they're the only ones that have the money to keep building the same buildings over and over and over and over. I mean, they got so much money, they have no problem building these storage buildings. But just one thing happens to one of those companies, it's over. All right, that's about it. So let's see what happens tomorrow on the on NVIDIA. And then also, be careful with the banks. Just, again, when you see the banks going up, snapping back, don't jump in, okay? Because these snapbacks are people who are moving out of these 12 stocks and they just want to put their money safe and they're putting it in the bank, so they snap back a little bit. But as far as the overall reasons why the banks are going down is still there, and the overall reason why these yields, where we hit the killer at 4.5, 4.6, and when it starts coming back down below 4.5, then it gets worse and worse and worse as we head towards 4, and then you finally break 3. That's where you make a ton of money. When it turns around and we're no longer at 4.5 anymore, okay, the yield's no more at 4.5, as she starts breaking through that 4.5, it starts going down, heading towards 3.75, that's where you make a fortune shorting. So that's where you can make a lot of money, okay, right now in this sector, but just understand what it is, okay? All right, I'll see you on the charts tomorrow.
Are you nuts?